What do you picture when you hear the words market crash? Most of us imagine something sudden and dramatic, a single day where everything collapses. You see breaking news alerts flashing on your screen, headlines screaming about panic in the streets. But the truth is, real market crashes almost never feel like that while you're in them. Most of the time, they don't feel dramatic at all. They feel slow. They feel confusing. And they feel deeply uncomfortable in a very quiet, unsettling way. And that slow, grinding uncertainty is exactly why so many investors end up making costly mistakes. It's not the panic that gets them, it's the confusion. Today, we're going to talk about what a market crash actually feels like in real time, so you can be better prepared for the emotional roller coaster when it happens. We all like to believe that when a real crash happens, it will be obvious. We imagine a clear, undeniable moment where everyone looks at each other and just knows this is it. This is the big one. We think there will be some signal, some giant red flag that no one could possibly miss. But markets simply don't work that way. Think about it. Prices move up and down every single day. The news cycle is relentless, constantly shifting from good to bad and back again. For every expert on TV saying the sky is falling, there's another one saying it's a golden buying opportunity. At the beginning of most major crashes, the market doesn't look like it's collapsing. It just looks volatile. You'll see a really bad week. Maybe the market drops 5 or 6%. Then, the next week, it rallies back 3%, and you breathe a little sigh of relief. Then, it drops another 4%. Nothing feels conclusive. There's no final verdict. And because there's no clear signal, what do most people do? They hesitate. They wait. They tell themselves, I'll just see how things play out. This hesitation, born from a search for clarity that never comes, is the first and most dangerous trap of a market crash. So what does it actually feel like for the average investor in the middle of this slow-motion decline? Well, contrary to popular belief, most people don't feel outright panic, at least not at first. The dominant emotion isn't fear, it's confusion. You start checking your portfolio way more often than you should. Once a day becomes 3 times a day, then 10 times a day. You find yourself glued to financial news, reading every headline, trying to piece together a story that makes sense. You're looking for answers, for reassurance. You start asking yourself questions like, is this just a normal dip? Is this a correction or the start of something worse? Should I sell now, or should I wait just a little longer in case it bounces back? And the hardest, most frustrating part is that there are no clear answers to those questions. The market doesn't send you a notification explaining its intentions while it's falling. There's no clear announcement, no checklist you can follow. Just hindsight, which only becomes obvious after the fact. And that's what makes crashes so difficult. You're forced to make decisions without knowing whether they're right, wrong, or too early. There's no announcer saying, "Attention investors, we are now entering a bear market." There's just the slow, quiet, draining experience of watching your account value go down. Day after day, week after week, with no end in sight. If we look back at history, this pattern becomes incredibly clear. Take the infamous crash of 1929. We think of it as happening on one day, Black Tuesday. But the market didn't just collapse in a single moment. It was a chaotic series of sharp drops, followed by surprisingly strong rallies. After each rally, many investors genuinely believed the worst was over. They jumped back in, only to be hit by another wave of selling. This happened more than once. Or look at 2008. The financial crisis didn't feel like a full-blown crisis to most people until well after the market had already fallen significantly. Lehman Brothers collapsing was a huge event, but even then, many professionals were unsure of just how bad things would get. The feeling on the ground wasn't immediate, widespread panic. It was a growing sense of dread and disbelief. Even in 2020, with the incredibly fast drop caused by the pandemic, what did most investors do? They froze. The speed of the fall was so shocking that people were paralyzed by indecision. They weren't sure whether to sell, buy, or just do nothing at all. Each of these crashes looks totally different on a historical chart. But the emotional experience for the people living through them was remarkably similar. A period of intense confusion, uncertainty, and a desperate search for answers that weren't there. This brings us to the single biggest mistake people make during a market crash. And it's not what you think. It's not panic selling on the very first bad day. A few people do that, but it's not the most common error. The most common and costly mistake is waiting for certainty. It's the impulse to wait until things make sense. Waiting until the headlines improve. Waiting until the experts on TV finally agree on something. Waiting until the market feels safe and calm again before you make a decision. The problem is, markets don't offer that feeling on your timeline. By the time everything feels safe and secure again, prices are usually much, much higher. The best opportunities have already passed. And on the flip side, by the time the fear feels completely overwhelming and everyone is convinced the world is ending, much of the damage has already been done. Waiting for an emotional signal, either safety or total fear's a losing strategy. Because those feelings are lagging indicators of what the market has already done, not leading indicators of what it's about to do. So what does history actually show us? It doesn't tell us when the next crash will happen or how deep it will be. Nobody knows that. But it does show us something incredibly important about human psychology. Every major crash in history felt permanent while it was happening. In 1932, in 1974, in 2009, it felt like the system was broken for good. And yet, every single one of those crashes now looks temporary when we view it in the past on a long-term chart. That realization doesn't make going through a crash any easier or less painful. It just means that the hardest part of investing isn't predicting the crash. It's not about being a genius who can time the market. The hardest part is living through the gut-wrenching uncertainty without letting your emotions take over and force you into a bad decision. Ultimately, market crashes are not tests of your intelligence or your analytical skills. They are tests of your behavior. They are tests of your emotional discipline. Understanding what they actually feel like ahead of time, that slow, confusing, uncomfortable grind doesn't make them painless. But it can help you recognize that feeling of uncertainty for what it is, a normal, expected part of the investing process. And sometimes, in the middle of the storm, having that perspective is the single most valuable asset an investor can have. This is the Long View Finance. If you found this helpful, you'll find more videos here exploring money, markets, and financial history.